This will take any one of us on the team and make us ashen, just the thought of it, where the stock never re-rates upward. And you have to go to clients and explain why it's still in the portfolio. But what we can do is get companies where valuation is important. And particularly as interest rates rise, whether it's just nominal rates because we see a bit of inflation, or even better, as real rates rise, that means the discount rate rises on all stocks. And all the stock is, Eric, is just the present value of all the cash the business can generate into perpetuity, discounted to present. And as the discount rate rises, that stream of cash flow is worth less. So getting more of the income of the stock up front, or that shorter duration, is very useful as rates rise, and that speaks to value stocks. Most of the companies that we follow generate quite a bit of cash flow, or they're on the cusp of doing so, and they do it now. We don't have to wait a decade for cash. It's all about today. You may not be overwhelmed with their sales growth, but that cash is valuable, especially that gets returned to shareholders in the form of dividends and or buybacks.
Sarah, many investors are thrilled that the Fed has taken such an interventionist role in the recovery. You have concerns, and you've termed one of your concerns the socialization of markets. Tell me more about this.
Eric, it's either the socialization or the nationalization of risk, depending on what mood I'm in. But when I get despondent, I use the word socialization, because really for the last several decades, but it's been exacerbated from the global financial crisis of late 2008. As a populace, we expect our governments, and particularly our central banks, to be there as a bailout mechanism. And perhaps we're taking a cue from Japan, where the Bank of Japan began in 2001, just about the same time that we founded Causeway, roughly 20 years ago, to go about massive monetary stimulus to create a bit of inflation. And it hasn't worked. But all that time, all that money creation, and then think about a central bank after buying all the treasuries and whatever mortgage backs they can find, or whatever else, they go into the stock market, which has happened in Japan. 25% of the top 400 stocks in Japan, their top 10 holdings include the Japanese government. That may sound like an anathema to us in the West. Oh, that'll never happen. But it could. I mean, it depends on to what degree we expect our monetary authorities to continue kind of perpetual quantitative easing, and to what degree they'll ever be satisfied with a level of inflation. It may very well be due to demographics and technological changes. Inflation is going to be defined differently in the future. But we will see. All I know is that as a value manager, we want markets to function freely if we can. And we think it's very helpful. It allows us to use valuation tools without worrying about an artificial influence. And if investors are willing to take risk because they think that there will always be policy support, then that's a distortion, and distortions make it a little more difficult if you use valuation and what I'd call a large dose of common sense and financial analysis to make decisions. It creates policy distortions may create a much more favorable environment for momentum investing, which had been dominating markets right through last November.
As a value investor, you need cycles, right? What if
we do, and we believe in them.
What if this is the end of cycles?
I would stake my entire reputation on the fact that cycles are indomitable. They can't be ended. We can try, and what will happen is with this nationalization of risk, with this sort of seemingly endless amount of policy support, all that does is postpone the inevitable, which is more sharp corrections. And perhaps that was some of what we saw in the meltdown in markets last March. Very sharp correction and then a very steep recovery. But that doesn't mean to say we're on a smooth glide path. And that's one of the reasons now why we are positioning our client portfolios in more economically defensive areas. Not only are they undervalued, But we want to take risk off just in case we have some sort of reaction. Could be just because rates rise and markets pull back, or there is some other outcome of what has been, again, an absolutely mind-boggling amount of monetary and fiscal stimulus.
There's a raging debate out there about the risk or not of inflation. What do you think? What do you see?
Almost every company we talk to, Eric, and we interview hundreds of companies throughout the year, and we must. There are either they're portfolio companies or they are companies we're anticipating adding to our client portfolios. They may be competitors or suppliers or customers, but all of them